Hi class, and welcome to the lesson on national income. My name is Nick Bergen. I'm going to be your instructor for the class, and we're going to learn today about national income and what national income entails. If we look at national income, we're looking at total income for the U.S. economy. So if you look at yourself, your family, they have an income that they earn every year. Well, we're going to look at the same thing. But we're going to look on the basis of how we can make those explanations on national income for the U.S. economy. So we start with GDP, which is gross domestic product. When we look at gross domestic product, what is the U.S. economy producing? We produce a lot of stuff, but we have to understand what we produce, and we're going to do it in two different ways. You have this word total expenditures, which is looking at what we spend money on things that are produced and what we earn money on. So we go out and produce stuff, and the stuff that we produced, we earn money on that. So total expenditures, so things we spend money on, is income that we earn. So for an economy to work, we have to actually make something, which means we can actually earn something for that. So the money we earn, we actually buy things, and that's how the economy operates. That's a very important thing. So the sum of things we spend is based off of, the sum of what we earn. Here's an example of a very simple circular flow diagram. It's connecting, as you see, households and firms. That's businesses where you buy stuff. Households, look right here, households supply themselves, that's the labor. We go out and work at, let's say, Best Buy, and they give us in return money for that labor, income. So firms give us money, wages. What do if I'm a household and I just earn money at Best Buy? I go and I spend, that's where the word expenditure comes in, money at a store where stores supply stuff. It's a very simple way of looking at our economy and how things operate. So this value added approach is looking at how much did the firm's value added in the value of its outputs minus intermediate goods and things to produce goods and services. So we're going to look at that and try to make a determination on that. Value add is how much did I add to the actual operations. So we're going to look at an exercise or a problem, right? And it'll make it a little bit easier. Farmer grows a bushel of wheat for $1 and sells it for $1. The miller turns that wheat into flour, sells it to the baker for $3. The baker uses the flour and makes bread and sells it to an engineer for $6. The engineer eats the bread. Now, when we calculate our GDP, we got to make sure that we're not over-calculating all of these steps. So how do we compute this? The value added at each stage of production will give us the GDP, or how much did we sell the good for? That will be another way to look at this. So if we look at things, we want to evaluate the final good that we sell to the bread that is sold will be our final good, $6. That's what will be added to our GDP. You also can add the steps or the process as well to count GDP. So that's two different ways that we look at, but it's just an example. With GDP, we don't calculate the intermediate steps and the final goods. We only calculate final goods in the calculation. So the expenditures, so what is GDP focused on? Consumers, investment, which is businesses, it's not investing in the stock market, government spending, and the international sector, which is net exports. So those are our four components of how our economy is derived. Consumers. So consumers buy a lot of things. They buy durable goods and services, durable goods, non-durable goods, and services. We buy a lot of services compared to goods in the U.S. economy. Look at the U.S. consumption in 2020. 70% of the GDP was consumers. So if I'm going to do things to help our economy, I'm going to stimulate the economy through the use of consumers. We want consumers to spend money. And you notice 40% of what consumers spend money on is services, which is an important aspect. Now, business investment. Well, what do businesses spend money on? They spend money on capital, which is machines used to produce goods and services. They spend on goods bought for future use as well. So this includes investment in plants, equipment, that's the machinery. They also spend and calculate business investment as houses. So any houses are calculated in business investment. And we also look at inventory. So inventory is another big one that we focus on. An inventory investment is looking at changes in inventory in terms of if I own a restaurant and I try to invest in terms of how much salmon people are going to buy, that's an investment opportunity as well. And you'll notice that investment in capital. So capital is the factors of production. And we learned that 2 weeks ago with regard to one of the factors is gathering the capital used to make goods and services. Now, investment, that is spending on new capital, buying new machines and equipment that we think the economy will need. So just an example, economy has 500 billion worth of capital, investment of 37 billion, economy will have, so they have 500 billion already, they invest another 37 billion, they're going to have 537 billion worth of capital. That's how we calculate this in terms of the capital, in terms of investment. Another thing that we want to look at is the difference between a stock and a flow. And we'll put an example to this. A person that's savings, that's the continuous amount that I save every week or month. That is a flow. My wealth is the stock. So if you look at this tub right here, my wealth is the tub. I keep flowing money in. That is my savings. Number of people with college degrees or number of new college graduates. So more people that go to college and get degrees, that's the flow that's going in. That will tell us how much in terms of college degrees. So just an example of stock versus flows. The other thing we want to look at is government spending. So government spends money on two things, goods and services. They spend money on roads, buildings, constructions, and those are included in GDP as well. Another thing that we want to look at is the calculation of the identity of GDP, which is consumers, businesses, government, international sector. Those are the most important components of GDP that we want to look at. You'll notice that consumers are going to be the most important, 70%, but we have to find ways to stimulate our economy to get the economy or GDP increasing. So here's a question for you. If a firm produces 10 million worth of final goods, but only sells 9 million worth of goods, it doesn't really equal that expenditure and output identity. We didn't sell what we produced. And then why does it? Look at it. We have to look at inventories levels. So if I produce 10 billion, but I only sold 9 billion, that means we're going to have a buildup of about $1 million worth of inventory that we didn't take into calculation. So these are some of the tricks that we're going to build on within the lecture in the practice problems that I give you in terms of the calculation. So one last thing is to look at GDP. And GDP is a very important concept as it looks at and measures income, how much is being produced, how much is being spent. So we look at earned, production, and being spent. And all of those GDP components will make up our national income in the US economy. Now in the lessons that I will present next week, we will look at and grow GDP, but this week I want you to make sure to look at the practice problems I provided for you. And please reach out to me if you need any more assistance and look at the certain videos that I did on certain practice problems as well, as they will help with your efforts. If you have any additional questions, please let me know, but I look forward to your effort.